Welcome to Growth DSY. On this channel, we talk about money the way normal people deal with it with confusion, responsibilities, and questions we were never taught in school or college. So, if you're someone who's just got placed or you're stepping into your first job after being a student, there's a high chance your salary slip looks more like a puzzle than a document. Every month, your salary gets credited, but the slip looks like a maths exam you didn't study for. PF, TDS, CTC allowances, deductions. And suddenly your 25,000 rupees doesn't look like 25,000 rupees anymore. I'm no finance guru or expert, but I'm here to share real-life experiences and the mistakes I made in building my career so that you don't. Before we hit 1,000 subscribers, make sure you subscribe right away and comment your subscriber count in the comment sections below. Now the big confusion, CTC versus take-home salary. CTC, cost to company, means the total money a company spends on you in a year, not just what you take home. It includes your salary, PF, gratuity, insurance, taxes, and other benefits. For example, if your CTC is 3 lakh rupees per year, it becomes 25,000 rupees per month on paper. But after subtracting PF, insurance, and taxes, your in-hand salary is lower, around 20,000 to 21,000 rupees. In simple words, CTC is the company's total cost of hiring and maintaining you as an employee. So don't fall in love with the CTC. Your relationship is with the take-home. Make sure to watch till the end, as I'll be breaking down a full salary slip with real numbers and showing you how all these components come together to form your final take-home pay. Moving in with Provident Fund PF looks like money disappearing, but it's actually your money, just locked in an account. Typically, around 12% of your basic salary goes into PF. If your basic salary is 20,000 rupees, 12% of it, that is 2,400 rupees, is saved from your salary by you, and another 12% is added by the company. So 4,800 rupees is saved every month in your PF. It's like money your future self will thank you for, even if your present self hates it. Up next, we have tax deducted at source. TDS is the government saying, don't worry, we'll take our share first. So instead of you saving up tax and panicking at year-end, it's quietly deducted every month. For example, if your salary is 25,000 rupees and 1,500 rupees goes as TDS, you get 23,500 rupees. And yes, your tax is already paid before you even notice it. Next, we have allowances, the fake happiness section. Allowances feels like free money, but they're not always. House rent allowance, HRA, travel allowance, medical allowance. Some are taxable, some are partially exempt. Now, let's move on to deductions. These include Provident Fund, tax deducted at source, professional tax, along with other deductions like insurance premiums, gratuity, and various allowances. In the earlier segment, we already covered TDS, PF, and allowances. So in this part, we'll focus on the remaining deductions, giving you a complete picture of how these affect your take-home salary. Insurance. This includes any health or life insurance premiums deducted from your salary. Gratuity. This is a provision made for employees who stay with the company long-term. Although it's paid out at the end of employment, there is often a monthly deduction as a provision for it. Professional tax. PT. A tax that is levied by some states based on your salary, typically deducted by your employer. By the end of these deductions, we arrive at your net salary, which is the amount credited to your account after all these deductions are made. Here comes the most awaited section, where I break down a real salary slip step by step. The annual CTC here is 4 lakh rupees, which comes to 33,333 rupees per month when divided by 12. Out of this, the basic salary is fixed at 40% of the monthly CTC, which is 13,333 rupees. House rent allowance is calculated as 45% of the basic salary, so that comes to 6,000 rupees. Other fixed allowances are 1,600 rupees. After fixing these components, the remaining amount required to reach the gross salary is treated as special allowance, which works out to 10,000 rupees. When we add basic salary, HRA, other allowances, and special allowance, The gross monthly salary becomes 30,933 rupees. From this gross salary, deductions are made. Provident Fund is deducted at 12% of the basic salary, which is 1,600 rupees. Professional tax is 200 rupees. Income tax deducted at source is 200 rupees. And insurance or other deductions amount to 300 rupees. The total monthly deductions therefore come to 2,300 rupees. After deducting this amount from the gross salary, the actual take-home salary credited to the bank account is 28,633 rupees per month. This is why a fresher with a 4 lakh CTC does not receive the full CTC amount in hand. This was the real picture behind a salary slip. Once you understand this, managing your income becomes much easier. If you found this helpful, do subscribe to the channel for more simple and practical money basics.